Salam, I'm Tosem, and thanks for tuning into the Think Work podcast. As you already know, we talk about many topics on this podcast, starting from role models, entrepreneurship, psychology, and one of the topics are also finance. I'm on a journey to explore how money works and try to understand the economy. So, in the beginning of this journey, I thought to truly understand money, I think history is very important. On this episode, I'm going to explore with you the history of money, starting from the first trades that were recorded in ancient Egypt to the first coins found in current Eastern Turkey. I'm going to talk about the toxic relationship between gold and the US dollar, aka the Nixon Shock. After the Nixon Shock, we're going to forward a few millennia to the famous year 2008 and talk about the economic crisis. Last but not least, our current time, 2023, the recession gossips, including the failure of Silicon Valley Bank. Yes, we have a lot of thinking work to do for this week, so I'm not going to lose any time. Let's start. Before money existed, humans relied on bartering, which is an exchange of goods or services. So the earliest records of trading date back to 900 BC in ancient Egypt. This practice was common in other ancient societies like Mesopotamia, China, and Greece. The economy back then was primarily based on crops and livestock. Farmers would exchange their surplus crops for goods such as textiles, tools, or services. So let me give you an example of bartering. Imagine there is a skilled hunter called Nebamun and a carpenter named Senusret. When I say Senusret, don't think about the one guy that slaps the meat and just salts it like snow. This one is Senusret the farmer. Oh no, the carpenter. These two names are, by the way, legit ancient Egyptian names. I did my research. So the carpenter approaches Nebamun the hunter and says, "Hey, oh Nebamun, there is a bear endangering my family and I know you're the best hunter in town. If you kill this bear for me, I will give you 3 sacks of rice and I will make a nice carpet for you so you can gift it to your wife," for example. So this system of bartering worked quite well as it was based on fulfilling essential needs directly related to demands. However, as time went on and the global economy grew, problems arose, of course. There was not really a standardized value for goods, as the value was determined on case-by-case basis. For someone, like endangering your own life for 3 sacks of rice is okay, but for someone else, it is maybe out of the question. So it became challenging to find trades with mutual benefits. So what did humans do? So they thought to invent something that can serve as a universally accepted measure of value, so we can make the economy more efficient. So they realized we need money. But did the invention of money really put an end on ancient bartering? Not quite, actually. During the economic downturns, it has been recorded that people often go back to bartering. And this happens in situations of short supply. If you remember COVID times, people were selling toilet paper. Or it also happens when money experiences hyperinflation and losses in value. So if you look at Venezuela's ongoing crisis, for example, banknotes have been so devalued that they are literally thrown on the streets. Bartering also regained popularity during the 2008 economic crisis. We're going to talk about it in a few minutes. So around 300 years later, after the first trading was recorded, the first coins were discovered, credited to the Lydians. And Lydians inhabited the region that is now known as Western Turkey. So minting refers to the process of creating coins. And King Eliates of Lydia is believed to have minted the first official currency. These coins were made from a mixture of gold and silver, and if I'm not wrong, it is called electrolytes. Archaeologists have unearthed numerous coins dating back to the Lydians, and these coins are beautifully engraved with tiger motifs. I'll post some pictures on Instagram so you can see. So for over 2,600 years, gold and silver have been highly valuable, with gold symbolizing justice, value, power. Gold had, and still has actually, a significant impact on modern-day economy, but unfortunately, governments and politicians changed the way we look and trade gold. So let's talk about paper money now. Paper money, it sounds so strange to me, paper money. But yeah, how did it come about? We owe its existence to Kublai Khan, the founder of the Yuan dynasty in 13th century China. China was an empire with diverse regions and various local currencies and economic systems. The introduction of paper money helped solidify the economy and actually centralize Kublai Khan's authority. We all know this thanks to the renowned traveler Marco Polo. So according to Marco Polo, the production of paper money in China involved a very complex process using the bark of mulberry trees. The inner layer of bark, known as bast, was transformed into thin sheets of paper. The remarkable aspect of this system, as Marco Polo described it, was the level of trust and authority placed on these pieces of paper. Each note was treated as if it were made of precious metal. Forgery with these papers was met with severe consequences, including death. The invention of paper money during Kublai Khan's reign was a bold and innovative step that unified the Chinese economy. People placed their trust in these government-signed papers, and the invention of paper money remains one of the most significant inventions in human history due to its lasting impact on our modern financial systems. In the past, the Spanish peseta, Portuguese escudo, and the British pound were once dominant currencies, and we call these fiat currencies. Fiat means currencies backed up by the governments. Remember the word. So today, it is the US dollar. However, the American dollar is in somewhat a sketchy situation, and I believe personally it is due to its toxic relationship with gold. Let's forward a few centuries to the 1970s so I can explain why. Before the current fiat currency system in America, there was a financial system called Bretton Woods system, which was also followed by many European countries. The system was based on the gold standard. Under the gold standard, we understand that countries could exchange their US dollars directly for a gold at a fixed rate of $35 per 30 grams approximately. For example, if someone held like a specified amount, let's say $1,000, they could request a conversion into gold. They would physically receive gold bars or coins representing the value of US dollar. So yes, we can still exchange dollars to gold, but back then it was on a fixed rate. So all of this meant that a country's currency was directly linked to a specified amount of gold, and the printing of paper money was permitted based on the amount of gold a country had in its reserve. Keep this in mind because this is where it goes wrong. So the printing of paper money was permitted based on the amount of gold a country had in its reserve. But how and why did we abandon really the gold standard? It was a scandalous event known as the Nixon Shock. The Nixon Shock is not widely talked about, possibly due to its revealing nature of human greed. Let me provide you with more details about this event. So in the 1960s, many countries held millions of US dollars in their reserves because they basically trusted that America will follow the gold standard. They invested in the US dollar. However, in 1965, President Charles de Gaulle of France became skeptical and sent the French Navy to the American shores, demanding the exchange of gold at the official exchange rate. Other countries followed and demanded their gold as well. So it turned out that America had printed more money than the actual gold it had in its reserve. This led to difficulties for America in repaying these countries, such as France, Switzerland, Germany. Eventually, Germany decided to leave the Bretton Woods system, and the other countries followed as well. So the thing is, America did not have enough gold in its reserves to pay all these countries back. And I think till this day, it is not fully paid back. And as a result, the value of the US dollar dropped significantly against European currencies, and the situation looked really bad for America. In 1971, President Richard Nixon announced the exit from the Bretton Woods system, effectively abandoning the gold standard and transitioning to a fully fiat currency system. This decision sent shockwaves throughout the world. For the first time in human history, the evaluation of paper money was no longer based on a valuable and scarce resource like gold. Instead, the value of major currencies, including US dollar, became dependent on government regulation, monetary policy, and market forces. In the current fiat currency system, the value of money is now determined by factors such as supply and demand, monetary policies, economic conditions, and market confidence. The value of fiat currency relies on trust and faith that people have in the stability of the issuing government and its central bank, of course. Initially, many believed that the departure from the gold standard was a temporary measurement to save the US dollar. However, it is now out of the question to revert to the gold system, as the current system has veered off the path of justice. Investor Rick Rule says the gold standard wouldn't really work today because the politicians' class doesn't want any part of the system that constrains their power. Enough about gold. I think we can talk hours and hours about gold because it's almost as old as the ancient civilizations. So maybe we should dedicate a whole episode for gold only. Let's go to the famous year 2008. So who remembers what happens in 2008? I was a teenager when the economic crisis happened. I don't think Gen Z remembers what was going on. What do you remember from the economic crisis? Let me know. Let's go into detail what really happened back then. The cause of the economic crisis in 2008 is mainly seen as some financial products that banks offered. I don't want to get too technically, but we have to understand some concepts first. During the 90s, collateralized debt obligations, I know it sounds fancy, but hear me out. CDOs, we're going to call them CDOs, were introduced as a new financial product offered by the banks. They can be compared to buckets containing other buckets, and these little buckets are containing a mix of mortgages, loans, or bonds. So these are all coming from people like you and me. And all these buckets were then tagged with a risk rating. So how higher the risk, how higher the return. And then these buckets were then taken and sold to investors. But why? So basically, banks make money by lending people and charging interest on loans. Selling loans through CDOs allows banks to receive cash in exchange for the loans, which can be used to make new loans and earn more interests. That's the reason why they sell it. So then the second product, so we had the CDO, the second product, credit default swaps. CDSs, on the other hand, function as an insurance against the possibility of borrowers defaulting on their debts. Defaulting means quitting, actually, not being able to pay back. So if a default occurs, the CDS buyer receives compensation from the seller. CDSs can be used to reduce risk or speculate on the ability of borrowers or companies to repay their debts. So basically, it's like a protector in case your friend doesn't pay you back. So although CDOs and CDSs were welcomed as innovative financial products on Wall Street, not everyone fully understood their risks. And according to the traders on Wall Street, who actually helped founding these financial products, they say that there was a lack of awareness regarding the potential dangers associated with these two products. So if you want to learn more about CDOs and CDSs, I recommend watching Money Power Wall Street. Also, take ChatGPT with you because you're going to have to ask a lot of questions. That was my case. So in 1999, President Bill Clinton signed the Leach-Bliley Act. This act allowed banks to have a wider range of financial activities. The act actually aimed to motivate innovation in the financial industry. CDOs and CDSs actually quite benefited from it. So after Bill Clinton signed this act, a lot of things went wrong. The complex nature of these financial products and the lack of understanding led to inadequate regulation. Financial institutions had more freedom in utilizing these derivatives, and regulators couldn't monitor and control the associated risks. Now that I'm saying this, I immediately think about AI and Bitcoin because there is not really a clear regulation around the usage of artificial intelligence and Bitcoin because governments are really don't really understand what is going on behind there. But anyways, as a consequence, banks took advantage of the newfound freedom and they began selling toxic mortgages. So it was really easy to get a loan back then. It was almost buying like bread. Because it was really easy to get a loan from the bank, everyone wanted to buy a house. So what happened when demand increases? Housing prices skyrocketed. When people started defaulting on their mortgages, if you remember, mortgages are a part of CDOs. Investors suffered significant losses. So it led to the crash of the housing market and actually the economic crisis. So this happened all in America, but because the banks were quite working together, and especially the CDOs and CDSs were also used by European banks, Europe suffered also a lot because of the crisis, of course. When I learned that CDOs and CDSs were behind the economic crisis, I asked myself if they are still used today. And yes, they are still in use today, but with increased regulation and hopefully lessons learned, and we won't go through the same times again. Let's go to 2023 right now. Quite recently with the pandemic, we saw interest rates being really low. So why was it low? It was actually done to boost the economy and encourage people to take out loans and make purchases. So when everyone started taking loans, it led to unhealthy borrowing and lending practices. So people had more buying power. But what happens if you have more buying power? Prices will go up too. So this resulted in inflation affecting supermarkets, clothing, houses, rent, and pretty much everything in life became more expensive. And you probably already heard that some big banks like Silicon Valley Bank failed, followed by other banks like Signature Bank. Silicon Valley Bank, as the name suggests, is the bank where most startups in Silicon Valley store the money they receive from their investors. The bank specializes in serving the tech industry and offers products that startup actually needs. During the period of zero interest rates, during Corona, Silicon Valley Bank invested billions of dollars in bonds with a fixed interest rate. What are bonds exactly? So bonds are essentially, you basically lend money to the government by purchasing these bonds. In return, governments will then pay you back over a specific period with interests. So while the US government guarantees a fixed interest rate on its bonds, the Federal Reserve has the power to influence the interest rates in the economy, which can impact the demand and prices of bonds. However, following the COVID-19 pandemic, the Federal Reserve of America increased interest rates, which caused the value of the government bonds purchased by Silicon Valley back then to decline. So this made it really difficult for tech companies whose investments were tied to Silicon Valley Bank to raise capital. So as a result, thousands of people were laid off from tech giants like Facebook and LinkedIn, and it's still going on, unfortunately. So as the stock prices, because of these layoffs, went down of these tech giants, panic set in, and everyone wanted to withdraw their money. Silicon Valley Bank had to sell bonds they had bought during the pandemic at a much lower price in order to fulfill their clients' withdrawal requests. This created a ripple effect, and startup believes that they didn't have any money left in their bank accounts. So they rushed to Silicon Valley and withdraw their funds, and ultimately leading to the collapse of the Silicon Valley Bank. So now with the inflation on the rise and layoffs happening in the tech industry, people are talking about a recession or an economic downturn. I see we are indeed living in turbulent times, and it's hard to fully trust the government or banks considering the history of people suffering due to financial crisis. So when I did my research on money for this episode, I learned two things. People are very uncomfortable about talking and learning about money. That's the first one. The second one, banks and governments can't be trusted because government can regulate the cash flow. They can create money. They can just print more money. And banks are making a lot of mistakes with your money. So it's a sketchy situation going on for some time, actually. And the best way is actually making your money work for you. Our salaries go directly to our bank accounts. And even when we save money, it is in our savings account, which is in the bank. So what the bank does is they take your money and they make it work for themselves. Whoa, that was the end of the episode. I hope I didn't give you any headache. I don't know. I'm sorry. But I hope in the future I will have more chances to speak about money and economy. Maybe like about gold and Bitcoin. I really enjoyed doing research for this episode. Although sometimes I had moments where I just lost faith in humanity. But anyways, next week I thought I will upload the episode about Malcolm X, but I'm currently reading the biography, and I think there are so many details that I have to put in the episode, so I will just take my time with that one. In any case, Next week, I'll be back with more thinking work to do. Salama.